Hello everyone, welcome to EPK Capital's daily brief video. In this series we try and update you and make sense of all the important news from the world of finance that came out globally. So, without further ado, let's begin. The global financial markets on October 3, 2025, were dominated by a powerful and paradoxical narrative. Profoundly negative US labor market data was interpreted as overwhelmingly positive news, fueling a potent rally in risk assets. The surprise contraction revealed in the ADP private payrolls report solidified market conviction that the US Federal Reserve has no alternative but to cut interest rates, likely multiple times before the year's end. This wave of rate cut euphoria propelled US indices to new records, with the technology sector once again leading the charge. This optimism completely overshadowed the significant political dysfunction in Washington, where a US government shutdown entered its third day. The shutdown delayed the release of the official non-farm payrolls report, creating an information vacuum that the market perversely celebrated. The artificial intelligence (AI) investment theme continued its global march, with specific partnership announcements from OpenAI acting as a powerful catalyst for Japanese and South Korean equity markets. Mirroring the rally in stocks, the cryptocurrency market surged, with Bitcoin breaking past the psychological $120,000 level, driven by a dual narrative as both a risk on liquidity play and a safe haven asset against fiscal turmoil. Global Market Dashboard, closing levels for October 3, 2025. The day's trading activity resulted in broad gains across most developed markets, with technology-centric indices showing notable outperformance. European markets posted strong advances, while Asian markets were led by a tech-fueled surge in Japan. Indian markets, however, paused to digest recent gains. In-depth analysis, the shutdown paradox and the US market rally. The core driver of market sentiment was a stark contradiction. A major political crisis in the US was treated as a bullish catalyst by Wall Street, fueled by deteriorating economic data. The catalyst: weak data fuels rate cut frenzy. The single most important market driver of the day was the ADP National Employment Report. The report revealed that US private employers unexpectedly shed 32,000 jobs in September, a stunning reversal from consensus forecasts that anticipated a gain of around 50,000 to 51,000 jobs. This negative surprise was compounded by a downward revision to August's data, which was adjusted from a previously reported gain to a net loss of 3,000 jobs. This data was interpreted by investors as a clear signal of a rapidly cooling labor market, dramatically increasing the probability of imminent interest rate cuts by the Federal Reserve. The market is now pricing in a nearly 100% chance of a rate cut at the Fed's late October meeting, with an 87% probability of an additional cut in December. This expectation sent Treasury yields lower, with the benchmark 10-year yield falling to around 4.09%, making equities, particularly high-growth technology stocks, more attractive by comparison. The political backdrop: a government shutdown the market ignored. This economic narrative unfolded against a backdrop of significant political turmoil. The US government shutdown entered its third day, a development that has delayed the release of crucial economic data, most notably the official September non-farm payrolls (NFP) report from the Bureau of Labor Statistics, which was scheduled for October 3. The political rhetoric has also become more cautious, with President Donald Trump declining to rule out a recession and speaking of a period of transition, a sentiment echoed by Treasury Secretary Scott Bessent. The Republican strategy appears to involve leveraging the threat of permanent job cuts for federal workers to pressure Democrats into voting to reopen the government. Historically, markets have often powered through short-term shutdowns. However, the current situation presents a unique dynamic. The primary risk to the market's powerful rally was the possibility of a strong official jobs report, which would give the Federal Reserve justification to delay or reconsider its anticipated rate cuts. The government shutdown has physically prevented the release of this report, thereby removing the main source of uncertainty that could have derailed the bullish narrative. With no official data to contradict it, the weak ADP report became the de facto, unchallenged story for the state of the US labor market. This development effectively corners the Fed, as making policy decisions in a data vacuum is fraught with risk. The central bank is now more likely to err on the side of caution and proceed with rate cuts based on the last available, and decidedly weak, information. In this context, the market rallied not just despite the shutdown, but in some ways because of it. This creates a precarious situation for investors. The current rally is built not on a clear picture of the underlying economy, but on speculation about monetary policy within an information void. When the government eventually reopens and the backlog of data is released, it could deliver a significant shock to markets if it contradicts the weak economy narrative. Furthermore, this highlights a classic disconnect between Wall Street and the real economy. While investors celebrate the prospect of cheaper capital, a prolonged shutdown inflicts tangible economic harm through furloughed federal workers, reduced consumer spending, and delayed payments to government contractors. The market is therefore celebrating a catalyst that could cause damage to the very economy that underpins corporate earnings, exposing investors to significant data shock, risk and the potential for a negative feedback loop in the future. Sector Spotlight: the unstoppable global AI momentum. The technology sector was the primary engine of the day's gains across the globe, with concrete news in the artificial intelligence space providing a powerful tailwind. The OpenAI ecosystem effect. The day's most significant corporate news centered on OpenAI's expanding infrastructure projects. It was announced that OpenAI is partnering with South Korean semiconductor giants Samsung and SK Hynix to supply advanced memory chips for its ambitious Stargate AI Data Hub project. 8 The market reaction was immediate and powerful, with shares of SK Hynix soaring nearly 10% and Samsung gaining 3.5%. This was followed by another major announcement, a strategic partnership between Japanese technology conglomerate Hitachi and OpenAI to collaborate on AI, energy, and other strategic areas. This news caused Hitachi's shares to jump by more than 9%. These developments created a positive ripple effect across the entire global semiconductor and tech hardware ecosystem. In the US, major chipmakers including Nvidia, AMD, and Broadcom all posted solid gains. The market's reaction demonstrates a sophisticated understanding of the AI value chain as a tightly integrated global ecosystem. The news was not merely a positive for OpenAI or its direct investors, it was interpreted as a direct and immediate victory for its critical component suppliers in Asia. This shifts the investment narrative from a simple "US tech is strong" thesis to a more complex understanding of the global AI supply chain as a new, interconnected engine of growth, directly linking the performance of the Nasdaq, South Korea's Kospi, and Japan's Nikkei through a single, powerful theme. This growing dependence of leading-edge US AI firms on specialized foreign hardware, such as high-bandwidth memory from South Korea, also elevates the geopolitical importance of countries that dominate these niche but critical manufacturing sectors. Governments are increasingly likely to view their domestic semiconductor industries not just as economic assets but as strategic levers in global power competition. This trend aligns with themes discussed in the International Monetary Fund's recent World Economic Outlook chapter on industrial policy, suggesting a future characterized by increased protectionism, government subsidies, and strategic alliances centered on securing access to critical AI supply chains. European Market Review. A mixed picture. European markets showed a more varied performance, with strength on the continent contrasting with relative weakness in the United Kingdom. Continental strength. Major continental indices posted strong gains, with Germany's DAX rising approximately 1.3% and France's CAC 40 advancing by about 1.1%. This strength was largely attributed to the same global factors driving US markets: optimism around the AI boom and the prospect of Fed rate cuts, which brightens the outlook for Europe's export-oriented economies. The automotive sector was a standout performer, with shares of Stellantis surging nearly 8% after reporting strong US sales figures. Technology stocks, such as Dutch semiconductor equipment maker ASML, also performed strongly in this environment. UK lag. In contrast, the UK's FTSE 100 index finished the day slightly lower, down around 0.20%. This underperformance was not due to broad market weakness but rather to negative company-specific news that weighed on the index. Shares of credit reporting agency Experian tumbled 4.2% after a US competitor announced a new program that could reduce reliance on credit agencies, threatening future earnings. Losses in other index heavyweights, including BT Group and several major commodity and banking stocks, also acted as a drag, offsetting gains elsewhere. Macro context. Adding to the regional picture, the Eurozone unemployment rate for August ticked up to 6.3%, slightly worse than expectations. While a sign of modest economic softening, this data point also reinforces the case for the European Central Bank to maintain its accommodative monetary policy stance. Asian markets. Japan's tech sector leads, Hong Kong pauses. Asian markets were largely positive, with Japan's tech sector leading the region higher while traders in Hong Kong took profits after a recent strong run. Nikkei's tech-fueled surge. Japan's Nikkei 225 index was a clear outperformer, surging over 1.4% to close around 45,583.14. The rally was directly linked to the aforementioned Hitachi-OpenAI partnership news, which sparked a broad rally in Japanese technology stocks, including Renesas, Sony, and SoftBank. Providing a supportive monetary policy backdrop, Bank of Japan Governor Kazuo Ueda remained cautious on the timing of any potential rate hikes, signaling that policy would remain accommodative for the time being. Hang Seng takes a breather. Hong Kong's Hang Seng index fell by approximately 0.6% to 0.8% during the session. This decline was not seen as a sign of fundamental weakness but rather as healthy profit-taking after the index had posted a very strong rally of 4% over the preceding 3 trading sessions. Regional notes. Mainland Chinese markets, including the Shanghai and Shenzhen composites, remain closed for the National Day holiday. Meanwhile, South Korea's Kospi index was another regional leader, gaining 2.7% on the back of the positive news for its semiconductor champions, Samsung and SK Hynix. Indian market dynamics, digesting gains amid fee headwinds. The Indian stock market did not participate in the global rally, instead entering a phase of consolidation as investors weighed strong domestic policy support against persistent selling from foreign institutions. A day of consolidation. Indian markets were trading on Friday for the first time since a large, RBI-driven rally on Wednesday, as markets were closed on Thursday for a public holiday. After that strong rebound, which snapped an 8-session losing streak, indices opened weaker on Friday due to profit booking and closed the session largely flat to slightly negative. The Nifty 50 and BSE Sensex both ended the day down approximately 0.07%. Wednesday's rally had been fueled by the Reserve Bank of India's decision to keep its policy repo rate unchanged while announcing new measures to boost credit growth in the economy. The fee versus D tug-of-war. A significant headwind for the Indian market has been what market commentators describe as relentless foreign investor selling. This dynamic was evident in the latest available data, which shows a clear tug-of-war between foreign institutional investors, FIIs, and domestic institutional investors, DIs. This data quantifies the ongoing battle between negative foreign sentiment and strong domestic conviction. Despite a positive local policy environment, the market is struggling to advance against the tide of fee outflows. This makes India a compelling case study for emerging market risk in the current global environment. Even with a strong domestic story, the market is being held back as large foreign funds appear to be prioritizing exposure to the outperforming US market, particularly the AI theme, and reducing their allocation to emerging markets. Against this backdrop, the upcoming ASEAN summit, and a potential meeting between Prime Minister Narendra Modi and US President Donald Trump regarding tariffs, becomes a critical event that could either soothe or further spook this already cautious foreign capital. The digital frontier, Bitcoin's dual narrative fuels breakout. The cryptocurrency market experienced a significant surge, with Bitcoin's rally driven by a powerful confluence of factors that highlight its evolving role in the global financial landscape. Bitcoin surges past $120,000. Bitcoin staged a strong rally, breaking decisively through the $119,000 resistance level and trading above $120,000 for the first time in over 2 months. The broader crypto market followed suit, with Ethereum also rallying to touch the $4,500 mark before seeing a partial pullback. A confluence of bullish drivers. The rally was fueled by a combination of drivers that allowed Bitcoin to capture bullish sentiment from multiple angles. Full circle macro tailwinds, the same factors lifting equity markets, namely, expectations of Federal Reserve rate cuts and a consequently weaker US dollar, also provided a strong tailwind for Bitcoin, which is often seen as a risk asset that benefits from increased liquidity. Full circle safe haven demand. Simultaneously, Bitcoin was treated as an alternative safe haven asset. Investors sought it out as a hedge against the fiscal irresponsibility and political uncertainty highlighted by the ongoing US government shutdown. Full circle, October, seasonality. The rally was amplified by the historical trend of October being a strong month for Bitcoin's performance. This seasonal pattern, dubbed October by traders, can create a self-fulfilling prophecy as market participants anticipate and trade based on this historical tendency. In the past, Bitcoin was often viewed as a purely speculative, risk-on asset. On this day, however, it rallied for 2 seemingly contradictory reasons. as a risk-on asset benefiting from hopes of easy money, much like the Nasdaq, and as a risk-off safe haven benefiting from fear of government dysfunction, much like gold. This ability to capture bullish sentiment from both the greed and fear narratives simultaneously is a clear sign of its maturation. Bitcoin is no longer a fringe asset, it is functioning as a sophisticated instrument that reflects complex macro sentiment, acting as a barometer for both global liquidity conditions and the market's faith in the traditional financial and political system. Concluding insights and forward outlook. The market's behavior on October 3, 2025, underscores a singular focus: the prospect of Federal Reserve easing. This narrative has proven so powerful that it has inverted the traditional meaning of bad economic news and has allowed investors to look past significant political risk emanating from Washington. The path forward will be dictated by how this dominant narrative evolves in the face of upcoming events. Key factors to watch in the coming days and weeks include: Phil circle US shutdown negotiations, any news regarding a potential resolution or, conversely, a further escalation of the political standoff will be critical. A prolonged shutdown will eventually begin to impact the real economy in ways that the market cannot ignore indefinitely. Phil circle central bank commentary. In the current data vacuum, any speeches or statements from Federal Reserve officials will be hyper-analyzed for clues about their thinking and their willingness to act without a complete economic picture. Phil circle eventual data releases. The eventual release of the delayed non-farm payrolls and subsequent inflation reports will be a major market-moving event. This data holds the potential to either validate the market's dovish assumptions or deliver a violent contradiction that could unwind the recent rally. Phil circle geopolitics and trade. For emerging markets, the upcoming ASEAN summit and the potential for a meeting between the leaders of India and the US. On trade policy will be a key focus, potentially influencing the direction of crucial foreign capital flows. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel.